Hey, everybody. We're getting ready to, or you're getting ready to watch the next episode of SoCo's Most Interesting Podcast. Mark and I already know what we talked about. And Mark, give your little bit of an insight of a preview. What excited you about today's podcast, buddy?
Chris, I found it very interesting that, surprise, surprise, I have a different view on what most people think. And so, most people read something and they think one thing, and there's me off in the corner thinking something totally different. And that's just the way my mind works, I guess. So what about you, sir?
It was fun to talk about interest rates. I could do that for 8 hours in a podcast, especially with you, and just chat about interest rates. But I learned some interesting insights from you that I don't know that I even would have thought of them on my own after reviewing the article we both reviewed. So I found it a very interesting and rewarding discussion today.
Awesome. All right, let's watch it. Hey, everybody. Welcome back to SoCo's Most Interesting Podcast. I'm Mark Ditkof, and I'm joined here with my co-host, Chris Bongirno. Are we doing okay today, Chris?
I am, Mark. I'm doing great. How are you doing today, buddy?
Spectacular day. And I'm very excited to have the conversation we're about to have. So when you're ready, I'm ready to go.
Okay, let's do it. We're going to be talking about today, folks, whether it's a good idea to go to the Grand Canyon in wintertime. Or more appropriately, today we're going to talk about an article that came out. Where was it? Business Insider, Mark, I think is where we saw it.
That's right. Yeah, Business Insider.
Business Insider, and basically says that there is a consensus expectation that the Federal Reserve, in order to meet their targets, are going to lower interest rates in 2024 4 times. And there's at least one reputable advising company, ING, that based on their analysis of the economy and what's going on, could see as many as 6 interest rate reductions next year. And I want to preface this conversation, Mark, by saying nobody knows what the hell's going to happen. Nobody does, right? So I want everybody to keep that in the back of their mind. This is based on current information we have today and what people kind of think might happen. There can be unforeseeable things like COVID, like wars, like natural disasters that can impact lots of things that makes all of this analysis useless. So just don't get all of your eggs in the interest rates are going to really drop next year, because that doesn't necessarily isn't the end result of our discussion today.
And so, Chris, I also want to just get this from you. So when we say interest rates might drop next year, are we exclusively talking about mortgage interest rates, or what is Business Insider talking about when they say the federal interest rates could drop 4 times next year?
So we're not going to get too deep in the weeds, but I do want to go over this just real quickly, and that's an excellent question, Mark. The Federal Reserve does not directly influence or adjust mortgage interest rates. Mortgage products trade on an open market, and they're called mortgage-backed securities, and they're long-term bonds and investments. And those are similar investments with similar risks to U.S. government bonds and bills. And the U.S. bonds are not directly, again, typically influenced by the Federal Reserve, because bonds are sold at auctions. But they do control some interest rates. And the one that you primarily hear of is the Fed funds rate, or the Fed overnight rate. And those are rates that they are adjusting. So what we're talking about is the Federal Reserve adjusting the interest rates they control that then have an influence on federal bonds, federal government bonds, and mortgage-backed securities. So whatever the Fed's going to do has an influence on mortgage rates, but not a direct correlation. Does that make sense?
It does. So if they do drop rates 4 times next year, 6 times next year, whatever, technically the mortgage rates might not move at all, technically, right? There's a good chance they would follow, but I mean, there's no direct correlation. If this drops a certain amount, then mortgage rates will drop a certain amount. That's not the case, right?
Correct. And in a lot of cases, so mortgage-backed securities trade on this market, similar to the way government bonds trade, and in some respects, similar to how stocks trade. And so what happens with these mortgage-backed securities is they try to anticipate what the Federal Reserve is going to do. Are they going to raise? Are they going to lower? And then that market starts to adjust or build in or bake in what they think is going to happen. So what a lot of people don't realize is that when the expectation of the mortgage-backed securities market is that the Federal Reserve is going to raise interest rates at some point down the road, they start baking that into the interest rates now. So you see interest rates start increasing even before the Federal Reserve will increase interest rates. And then when they finally flip the switch and they increase them by 1/4 of a point, we actually see interest rates typically dip just a little bit.
Mortgage interest rates, you're saying? Okay.
Mortgage interest rates dip a little bit because investors like knowledge. They like stability. They don't like the unknown. So as soon as the Federal Reserve does what they say they're going to do, we see the risk go down a little bit. So interest rates on the mortgage-backed security side typically dip a little bit. And then depending on what the next prediction is, are they going to raise, are they going to lower, you'll see rates start ramping up to whatever that's going to be, whatever the anticipation is going to be. So now that we're seeing, so what we've had, Mark, in the last couple of weeks is actually a rally in the mortgage bond securities market. And what that means is that interest rates on mortgages have actually been coming down the last several weeks. And we're at lows right now we haven't seen since August. We're recording in the end of the first week of December, and we have the lowest rates that we've had since August. And there's a lot of technical part in that. We're not going to get in the weeds on why that's happening, but part of that is the expectation of what we're talking about today, that the Fed may lower rates in 2024.
Okay. Now, that was a lot. So everybody that's listening and watching, I hope you guys were able to keep up with that a lot. Really what the gist of everything we just said is, there's an article that is it's a verifiable article, good people that are putting it together that we trust, says that rates are probably going to come down next year from the Fed. That also then means there's typically a correlation, not directly, right? But when one goes down, the other one typically tracks along with it. So we could very likely see mortgage interest rates, which people have seen as higher than they've been in the last 15 to 20 years over the last couple of years, right? Those could start coming back down to maybe a point, definitely not where it was in COVID, 2.5%, 3%, but ideally somewhere that's going to feel a little bit more palatable to our buyer base and the consumers that are buying and selling houses. Okay, so that hopefully sets us up for the conversation, Chris, you and I want to have. And so I saw this article, you had already seen it. And so we were talking, and I said, do you know what? There's kind of 4 people that this affects most in the market, right? And when mortgage rates moves, you've got real estate agents, because their business is based on people buying and selling houses. You've got buyers, you've got sellers, and you've got loan officers, right? And so there's a lot of other influences as well in the market, but home inspectors and appraisers and all that also fluctuate through it. But those 4, exactly. But those 4 really live and die with mortgage rates,
right,
and confidence in those. And so you were reading it and I was reading it, and I told you, I said, Chris, you know what? It's funny because of the 4 major ones, I think it benefits all 4 people if rates go down next year, except home buyers. Right, which is funny because I think most home buyers are going to get really excited when they read that article and go, sweet, I'm going to have a lower interest rate if I buy a house next year. I'm going to wait till next year. But I'm going to throw out a word of caution and say, I think those are the people that are going to be most negatively affected by getting a lower interest rate next year.
Yeah. Yeah. And honestly, when I was reading the article, Mark, I didn't necessarily come to that conclusion first. I don't think you're wrong. I don't think it's 100% that they're not going to benefit. And I'll explain why in just a second. So kind of how I want to categorize or describe this rate reduction is it's going to take the pain out of interest rates. It doesn't mean that it's going to be like the insanity of the interest rates with COVID, like you said, but it's going to remove the pain. People are going to feel less pain when they go to get a loan. That's a good thing. On one hand, that will improve home affordability because as rates go down for a particular loan amount, the monthly payment will come down, that pain will go down. So on the financing side, you get affordability and a little less pain. That's me thinking as a loan officer. You are thinking as a real estate agent. Why don't you describe why, despite maybe the reduction in pain on the loan side, you see actually in the real estate market more pain for buyers?
So it's going to be very similar to what we did see during COVID, just not at that extent. During COVID, there were literally times where I had 70 to 80 showings on a house in one weekend. I'd have 20 something offers, and that was then excluding the offers I didn't receive from the other 30 buyers that knew they weren't going to be competitive, right? So that's what we saw during COVID. I think we're going to see a mini scale of that. So if I'm a home buyer, if I bought a house,
why do you think you're going to see that, Mark? Why is that going to happen now versus last month or the month before? What's the change that is going to happen to get people thinking now's the time to buy, when we roll into March, April, May?
So there's a couple of aspects that are obviously going to play into it, but one is the fact that there's a lot of home buyers currently sitting on the sidelines, either because they're hoping interest rates go down or they're literally priced out of the market and they're hoping for home values to come down. But what we've seen, if you watch any of our market update videos that we put out, is that home values have not come down at least enough to make any difference, right? We've seen like a 1% reduction year to date home prices, which means that on a $300,000 home, they've come down $3,000. Chris, as a lender, you're going to say that's not going to make or break somebody typically in regards to whether or not they can afford the house.
Inconsequential most of the time.
Yeah. And so since we're not seeing home values drop and we've got all these buyers waiting on the sidelines, waiting for lower interest rates, if they do drop, they're going to see that. I predict those home buyers are going to see that as the opportunity to say, okay, now is the time because home values aren't coming down. I got to get in on this. I want to buy a house. Well, now that rates have come down from, what a 7.5%, 8% is, when they were in their highs, now they're at 6.5% or 6% or whatever the Fed can get them down to, they're going to come out of the woodwork. And so what happens is, you're getting a lower interest rate, which is great. However, are you ready to, instead of getting a house at or below asking price with the seller paying closing costs, being a little bit more amenable to inspection items, all those things, to be back in a multiple offer situation? Because you're not the only buyer sitting on the sidelines right now waiting for those rates to drop. And so when it does, they're all going to come out and they're all going to be vying for the good properties.
Mark, talk just real quickly. What happens when you're in a multiple offer situation? Because I think you're right. I think it's really likely. And in my own business here in the last month, I've had 2 or 3 customers not get the homes they wanted because of multiple offer situations. So what are some of the things that create issues for buyers with multiple offers?
Well, imagine you're sitting at an auction, okay? And there's an item up for bid and you say that, that's the reason I came here. I'd really like to purchase that item, right? And the auctioneer's up front and says, okay, here's the starting price. And they just and all of a sudden some guy across the room says, well, I also want to buy that. And that's the reason I came here today. And so now it's not, you don't just walk up like you're going to Walmart and buy something off the shelf. Now you got people that are competing for it. And what happens? Price goes up and your ability to ask for inspection items goes down, your ability to get closing cost concessions goes down, and your ability to have a comfortable timeline based on the buyer's needs also goes down. A lot of times saying, what does the seller need? When do they need to close? Do they need a post-occupancy agreement, right? You're giving away a lot of your leverage the moment a second offer comes in. And that's just with one other offer. Now, if we start adding 3, 4, 5 offers in the mix, it's much more difficult to stay competitive without raising the price and giving away your power.
One of the things I had 2 weeks ago, Mark, with one of my customers is they were in a multiple offer situation. They offered full price, no seller concessions. There were I believe it was three other offers. Two of them were almost identical to my customers, but the one offer was for $5,000 above asking price. But more importantly, there was an appraisal gap. Talk about appraisal gap and why that creates an issue for some buyers. Explain what it is and why it would be an issue and why it was an issue for my customers. So my customers could have qualified for more. They could have made an offer for more than $5,000 of the asking price. But what would have been my customer's problem?
So an appraisal gap essentially says, right, I'm buying a house for $100,000. The appraisal comes in and it only appraises for $80,000. Well, I promise that I'm going to bring cash to the table above my down payment, above my closing costs, and above the home's value to cover that difference. And most people put a cap on the amount that they'll do an appraisal gap. I'll, go up to $10,000 above appraised value, something like that. But now what you're literally doing is you're buying a home knowing you're paying more than what a professional appraiser has said it is worth. Right. And so the day you buy it, it's kind of like driving a car off the lot, right? You know its value is below what you just paid for it, even though you haven't done anything to it. And so that's an issue if you turn around in a year or two and need to sell it and home prices haven't gone up to justify a sale of where you originally bought it from, you're underwater and you're kind of in a situation where it's tough to get out of sometimes. So that's another thing that, again, you're just giving up that leverage. And so going back to what we were talking about those, right? We've got real estate agents, mortgage loan officers, you've got sellers, and you've got buyers, right? Loan officers are going to benefit from lower interest rates, Chris. And you know this because not only are people going to be more comfortable buying homes and selling homes, they're going to be refinancing, right? All the people that have bought in the last couple of years that bought at 7.5%, 8%, they're going to be jumping on a lower interest rate because they're still earlier in their loan. And so it's worth doing. Sellers are going to love it because more buyers are going to come out of the woodwork and they're going to have the upper hand even more so than they do now. Us real estate agents are going to love it, right? Because buyers are going to come out of the woodwork. Our listings are going to sell faster. It's going to be a little bit easier to do our job. So buyers, though, they're the ones, if you bought in the last year or two, boy, you are in such a good situation. The ability to sell your home, refinance, do whatever you need to do to it to that lower interest rate potentially.
Exactly.
But if you are waiting for these rates to go down, you're going to be in the mix of things. And again, like you said at the beginning, great. Okay, if you can get a home at a lower interest rate, it's less painful, you're going to have more affordability. It's still a good option to buy. But if you can afford now, before the rates drop, and you're comfortable with the payment now, correct? Because the rates might not drop. But boy, if they do, what a benefit you're going to get by getting a home easier now and then being able to take advantage of a lower interest rate still in the future.
Yeah, absolutely. And the real downside for my customers that lost out on that appraisal gap is they didn't have the $5,000 to do an appraisal gap, right? So as a buyer, when all this competition is going to happen next year, even though rates are going to be lower, you're going to lose negotiation power for yourself, but other people are going to gain negotiation power, right? The people that have more resources. So it's going to be much more challenging. And I think what's important here to think about too, Mark, is we talk a lot about in the industry, not so much with our customers and so forth, but amongst ourselves, home affordability, right? And lower interest rates are going to make, as those come down, home affordability is going to get better. But like you said, we've seen values drop maybe 1% here in the last year. But if they go up by 3% next year, whatever home affordability you're getting from those lower rates may be eroded by this quick appreciation in home values, muted, but similar to what was going on during COVID, right? Isn't that what you're really, at the end of the day, that's really what you're talking about is less negotiation power and losing affordability because of quick value increases, correct?
That's exactly right. And so, as I say, if you can afford to buy a house now, and that's a big if, right? If you can't afford it, obviously you're going to be on the sidelines. You're going to be one of the many people that come when rates drop. But if you can afford it now and you just go, man, I'd really like the idea of a lower interest rate, buy it now. Be comfortable with the payment that it looks like now, but buy it now, knowing that if and when rates do drop, you still get the benefit of a lower rate if you can still qualify. And again, we've talked about this on previous episodes. But it's, assuming you can still qualify for a refinance and all those things, right? If you're the same person you were when you bought it today in a year from now, but rates are just lower, you're going to have such a better opportunity in front of you in regards to still capturing the lower interest rate, but you bought the house at a time where you got potentially closing costs paid for below asking price,
Right.
before extra appreciation, you got extra inspections and inspection items fixed, right? You got all the benefits of a closer to a buyer's market. And then once you swap interest rates when they go down, then you're going to get, again, the benefit of what is during the seller's market. You're just not competing for a house anymore.
Yeah. Mark, what do you see in terms of inventory over the next year if we're seeing interest rates come down 4 or 6 times, and whatever that Fed movement translates into interest rates? How do you see our inventory situation? Because I've got buyers right now that are qualified that want to buy now. And there's homes in their price range, but there's 3 homes in their price range. They don't like any of the 3, right? So they're trying to follow that advice of get it done now. There's just nothing that's coming available that they can really look at. How do you see the forecast over the next year?
Well, if rates go down, you're going to see a couple of things. Sellers are going to be more likely to sell a home that has a low interest rate. If rates come down, like there's a lot of sellers right now, they're at a 2.5% or 3% interest rate. They go, I'm not going to sell and buy something else at 8 or 7.5, right? But if they could sell and buy a house at 5%, well, that might be more stomachable, right? And so we're going to see more people jumping into the market because of that, more sellers, meaning more houses will come available. But that also means more buyers are entering the market because that seller is now a buyer, plus all the buyers that have been waiting on the sidelines for lower interest rates. And so we right now have about 3.5, maybe 4 months worth of inventory. That's still statistically a seller's market. If rates come down and enough buyers come to play, that inventory level is going to drop like it did during COVID. Again, not to that extent. We were between 2 and 3 weeks of inventory during COVID. My expectation is we're going to see between 8 weeks and 12 weeks of inventory. So it'll go from about 3 to 4 months right now, probably down to 2 to 3 months worth of inventory, which again, that's shifting it stronger to a seller's market, making it harder for buyers to get a house, even though that interest rate is lower.
And Mark, what's a normal market in inventory?
Perfectly balanced market where they say it doesn't have a seller or a buyer advantage. You're looking right at about 6 months. Some people say like between 5 and 7 months. Some people say right at 6 months. But either way, that's the idea, is that's the balanced market. Under that amount means there's not enough houses compared to the demand. And therefore it's a seller's market. Over 6 or 7 months, that means that it's a buyer's market. And so the buyers have the best, advantage.
One other thing that I want to throw out here, Mark, and something that you and I have talked about a little bit in podcast, but mostly individually offline, is, people buying a home now, like one of my customers who can't find the ideal home, but buying a home now, getting invested in real estate, waiting a year, refinancing during that period of time, keeping this home that they bought that's not the perfect one as a rental property, and buying the right home next year and leveraging their assets. And I think, it's a common theme that we've talked about with interest rates and with new loan programs. But I think that's an important consideration to keep in mind, because that interest rate becomes less important as a business operation than it does as your primary residence. So I think my advice to people right now is that if you're thinking about buying next year at all, get with a real estate agent, get with a lender, and find out if it makes sense for you economically and financially to buy before the end of the first quarter of 2024. Whether you're going to keep it as a rental or not, there's so many options. I think sometimes people don't realize there's a lot of options, and this uncertainty of what's going to happen in interest rates, even though there are advisors saying, hey, we're expecting the Fed to lower 4 to 6 times. When the Fed started raising rates, they thought they would raise rates 2 or 3 times. Right? When they first started that raising, they were like, hey, it's going to be somewhere between 2 and 3. And then, wow, it's 7, 8. Right? So that expectation isn't set in stone.
Right. It's the expectation either way, right? They say it's going to be 4 or 6 times next year. It might not happen at all. It
Right.
might happen 10 times, right? Who knows? Again, like you said at the beginning of this show, right? We don't actually know anything. It's just we're going based on the information we're being given. And then now we're
Right.
speculating and making assumptions based on if those things happen. Here's what I think it's going to look like. I'm excited to see what happens. Again, no matter what happens, the market moves on. If if you're looking to buy, if you if you buy right now and rates go down next year, great. Potentially you can refinance, right?
Right.
If you buy now and rates don't go down next year, but your property is now appreciated in value, well, great, you've got more equity. If you buy now and rates go up next year, well, now you feel great about the fact that you bought now and you didn't have to buy in higher rates. Like there's very few negatives if you can afford to buy now to do that.
Right.
And the expectation based on this article is that you buy now, rates go down next year, and potentially you can refinance to that lower rate. And again, you bought at the right time, you're going to refinance at the right time, and you're going to feel really good about your decisions.
Yeah. And one thing a lot of people say, well, I'm going to wait until rates come down. In your estimation, Mark, is that a good plan to start the process once rate hits their bottom? Number one, how do you know they're at the bottom, right?
Yeah, one, you can never know when the actual bottom is. But the other thing is, what if you do truly wait to even start the process until you think it's at the bottom, and maybe you're right, it is the bottom, and then you call somebody like you, Chris, and they go, awesome. Do you know what though? I need you to clean up some debt, or I need you to do this with your credit, and we're 6 to 12 months out before you can buy.
Right.
Right?
Right.
I mean, start that process now. Worst case scenario, they tell you, hey, we're not ready yet, but here's what you can do over the next, amount of time, and then we'll get you where you need to go. You should always have the information as soon as possible. And that way, at least if there are hurdles, you can start jumping over those together.
Mark, how much do real estate agents charge for advice before you buy a house?
Absolutely nothing, Chris. Most of them, I don't charge anything. I can't imagine there's anybody out there that does. We're
Right.
in the business to help people, just like you, Chris, right? If somebody calls you and they just want to know what it's like, what is a mortgage and how does it work and how do you buy a house, all of our advice is always going to be at no charge to anybody because we're here to help.
Yeah, and I think a lot of people are lost on that. Like they almost don't want to inconvenience us until they're serious. But I will tell you that information is so valuable. That's what's really valuable is information. And the sooner you get that information, the better prepared you're going to be to buy a house either next week or next year or 3 years from now. And I really try to communicate to people, don't wait to ask questions. Don't wait until you're ready. Ask questions now so that when you're ready, all of the other stuff that goes with buying a house is ready as well. Right? Because it's a complete package. And I have people that call and that, they can't make it happen now and they're very apologetic. I'm like, don't apologize. That's what we're here for. Let's get you in a position. Let's get your family ready to be homeowners. So Mark, final thoughts on this potential Federal Reserve rate reductions coming next year. What are your final thoughts on that?
I'm very excited. I think a lot of people are very excited to see there to be a little bit of a drop in interest rates. A lot of people have expected it to come since they started going up, and this seems like it might actually happen. And again, from a real estate standpoint, from a loan officer standpoint, from a seller standpoint, all but really just benefits, right? There's a lot of benefits to all of those people for this to occur. Buyers, obviously, there's really good benefits to getting lower rates. A word of caution, right? If you truly wait for them to go down, be ready to compete more so than you're having to right now.
Absolutely.
What about you, Chris?
Yeah, and that's kind of my thought is get prepared now. I'm looking forward to the interest rates coming down just so people aren't as freaked out because most of the time when I talk to people, they're like 7.5%, 8%, and it's so hard and everything's bad. And I just hate to see people having that kind of emotional reaction to the great joy that comes from buying a house. And so I'm looking forward to it so we can kind of change the message. So news media has a different message. We have a different message as an industry, and people again start looking forward to purchasing homes because I think for the last 6 to 9 months with all this interest rate elevation, it's really kind of put a negative feel for a lot of people. We really want to ask everybody to like and subscribe to the channel. Leave some comments for us. Let us know some topics that you would like us to cover. Doesn't have to be exclusively real estate or lending or that kind of genre. We're open for anything, right, Mark?
Yeah, I guess next week we're supposed to talk about the Grand Canyon in the middle of December, and so watch out for
Yeah,
that episode. It's gonna be a really spicy episode.
there you go. There you go. Mark, where can people find you for some real estate advice?
Yeah, if you guys look on any of the major social media platforms, you'll find us at Onyx Home Group. That's Onyx with a Y. Chris, where are they going to find you?
In the comments down below, Mark, because the spelling of my last name is a pain in the ass.
There it is.
Anyway, we are looking forward to the holidays coming up, Mark. And that's the other thing that I just want to put a bow, if you will, on the end of our discussion today before we close out. Don't wait for the end of the year, folks. If you're interested now's a great time to reach out and start talking to people. You don't have to wait until the end of the year. For Mark Ditkof, I'm Chris Bongirno. We will see you all next time on SoCo's Most Interesting Podcast.